All right, guys, welcome back. I'm here again with Paul. There has been a lot of conversation since our last discussion on growth versus income investing. And it's clear that people are genuinely curious about how these two approaches work in real life. If you're new here, I'm Darren. I'm just a regular investor who started late in life, but I'm focusing on building a growth-oriented portfolio. And this is Paul. You might know him from his channel, Better Call Paul. He takes a bit of a different approach, focusing on income through covered call ETFs. And you can check out his channel. It's in the video description below to see more of his perspective. Now, we're not financial advisors. We're just two investors sharing our real journeys, the wins, the lessons, and sometimes those really tough questions. What matters most to both of us is being responsible with the content that we share. There are a lot of new investors watching, and we want to make sure that nobody follows a strategy blindly. Our goal is simple: to help people understand both sides, growth and income, the pros, the cons, and the trade-offs, so they can make an informed decision that fits their own goals. All right, Paul, we actually share a lot in common, right? We're the same age, we have a similar portfolio size, but we totally approach things differently. Now, you're withdrawing about $1,000 a month while I'm still contributing and you're living off of your strategy. I'm still building mine. You've called this your case study. So what does that mean to you, and what do you want people to take away from it?
Hey, Darren. Thanks for having me again on your show here. I guess this is our second month, and I'll tell you right now, the feedback that I got from the first one was very positive. People really like to see the two of us together sharing opposite, spectrums or opposite ends of the investing, growth versus income, but doing it in an amicable way. And, the last couple of days on Blossom, I've been reading a lot of comments and talking to people. And I think people got the wrong idea about me, that I'm like a covered call cult master, trying to convince people into it. And it's not true at all. I think like Mo's XEQT strategy is fantastic. Other guys that are using VFD or, other growth indexes, that's a phenomenal way to go, especially for a younger person who's, working towards accumulating. And so that's what I recommend to a lot of people, which I think some people might be surprised to think that I'm not encouraging every 19-year-old to go 100% into covered call ETFs. But to answer your question about my case study is only a portion of my portfolio, right? Well, my RBC TFSA, which is about $60,000, and it's currently generating about $1,600 a month in distributions or dividends, which is phenomenal. And what I'm doing is I'm pulling out about a 22% yield, which is that $1,000 a month. For my other portfolios, I'm also pulling out other money because obviously I can't live on $1,000 a month. But the purpose of that case study is just to see whether or not taking $1,000 a month out of the portfolio will diminish the balance to zero. And then, of course, it would be useless, right? And I've had a few people like, I don't know if you follow the Dividend guy, Mike Carew. He said that he thinks my portfolio will last about 5 years. And just taking, if you do the math, it makes sense, right? Take $1,000 a month out of 60 grand, it'll last about 5 years. But so I'm trying to prove that it's going to go forever, infinitely. Just keep reinvesting the balance, which is about $600 a month right now, and to keep withdrawing the $1,000, and I think it should last forever.
Right. That leads to the next question, which I think is well suited here. So when you started drawing income, so what gave you that confidence that your portfolio could sustain itself? Because you must have known that before you jumped into this.
Well, I first came up with this idea back in May, and it seemed like it would be an interesting sort of like a case study to post on Blossom. I did not have a YouTube channel at the time. I had no intentions of starting a YouTube channel at the time. I was working full-time at that point, or I was working at least 4 days a week. The whole purpose of doing it was, if it's going to fail, I need to know now, right? I don't need to find out that it's going to fail after I'm unemployed and I'm really depending on the money. So the whole point was to jump in and do it ahead of time and learn whether or not it will actually work. Then, as you all know, I ended up getting laid off on September 1st. So didn't really have a lot of time to see if it was going to work or not, but so far it has done really well. I personally think it's done better than I thought it was going to do.
Right.
Yeah.
And how does it feel to see that income coming in each month compared to when you were working?
Well, it's great. Yeah. I mean, especially this month, I'm going to break another record. I like to, I guess, call them records or whatever, but another monthly total this month. The last couple of months, I was just over 10,000 a month in income, and I'm really trying to get to that $11,000 mark, and I think I'm going to hit 12. I think I'm going to hit 12,000 this month.
Wow,
Yeah.
that's a big number. I think this is a good time for us to share our portfolios, because the whole purpose of you and I sitting down was to show what the different approaches look like. And you've already acknowledged that the approach that I'm taking is a good approach, depending on where you are in your life, your time horizon. You mentioned in the other video that you've got your kids doing this as well, and into the XEQT idea or into other securities. So I think it's a good time. I'll share on the screen where my portfolio has come over the last month. And for those of you that follow us, you know that we do monthly updates. If you're new, you should go into our playlists and you can go back and check those out. You'll see where the portfolios have moved over time. So what I'm going to share is, number one will be the total returns on the portfolio to date. And like we said in the intro, our portfolios are very similar sizes. When we decided to do this, we were sitting at about the $400,000 mark. I'll call it that. And so last month, my portfolio was sitting at $423,000. And I'll just pop this up on the screen. Okay, so folks, so what you're looking at on the screen is passive. It's a great tool to track all of your dividends and how much you're investing in your account, set up asset allocations, all great. But what it does is it will take, so I have Questrade and Wealthsimple, and then I can link those accounts to this, and I can see all of that in one place rather than having to go into each separate account. Now, it's not perfect by any stretch. There are some small discrepancies, but when I say that, it's a lag in time more than anything. So currently, as of today, and actually just before we started recording, it seems like the markets might be going down a little bit, because I noticed it's changed. When I started talking to Paul before we recorded, it was sitting around 441. It looks like it's dropped to $440,993. And for me, you can see that there's total contributions on the screen. That is not how much I've contributed. There's a big spike you can see. That was me moving some money, and unfortunately passive doesn't have a way to mitigate that. It thinks that I contributed a bunch of money, which I didn't. But that's not important. What we're trying to do is compare the portfolios as of today. So now Paul can pop his up on the screen and we can compare the two.
So down at the bottom, a couple days ago when I put this together, my current portfolio value was at 445,000. I actually had one day, I'm sure you had the same thing. October 27th, the market spiked, and that was my new all-time high. I hit 447,000. But like you said, the last couple days, the market's been going down. Yesterday, I was at about 444, and I think right now I'm probably like you at about 439, maybe 440. So we're actually bang on,
Pretty close,
just about
yeah.
the same.
So for the viewers here, what Paul's talking about is of course, he has his own channel, puts his videos, and he mentioned that in one of his videos or a post on Blossom, I think it was, that he was sitting at that we'll call it 446, 447. I checked my account when I saw that, and I was sitting about 446 as well. So now what I'm going to do is I'm going to throw up on the screen what happened in my account in the last month, so that you guys can see how my portfolio performs, and then Paul will be able to do the same. Okay, guys, so what I've put up on the screen is what I've done in the last month. And it's important to understand that, while the numbers are similar, something to keep in mind is I'm contributing. And you can see on the screen here on the far, well, I'm not sure how it looks to the viewers here, but you'll see net contributions. So in this last month, as I'm still building my portfolio, I put in $4,885 into my account. Now, I did a little bit of math to help you guys understand the metrics here. So, you saw that the account is sitting at, I based it off of 441 before we started recording. Last month, we were at 423. So the portfolio grew $18,000 over the last month. And then, of course, if we subtract that 4,000, so the total growth over the last month is $13,000 in my portfolio. Now, my portfolio is 90% equity for the most part, and I have actually, it's like a little bit less than that, 88% into equity stuff, and then I have 12% in covered calls. So that's how mine's performed over the last month. And again, I'll emphasize I am contributing. So whatever numbers you're seeing for Paul, keep that in mind.
All right. So last month, my balance as of September 30th, all my portfolios put together was 426,986. So as of today, right now I'm sitting at about 440,000. So that's an increase of $13,000, and I've taken out 2,000 this month. So I look at that as, I guess, a $15,000 gain.
Okay, so pretty close. So mine 13,000, yours 15,000. So very similar numbers. And I think probably one of the big questions that will be on people's mind is long term, what might this look like, right? So that's why we thought this might be kind of interesting to see how they perform together. So very similar this month. So interesting.
Yeah, and I'll keep in mind to keep better track for next month, so that when we meet again, I'll have the numbers ready.
That's all good. You're
Maybe I'll be
it'll
on passive by next month.
all right, guys. So we gave you guys a look, a deep dive into our portfolios, what's gone on in the last month, and the total returns on it. But Paul, I'm kind of curious. When you get that monthly distribution, what does it represent to you?
What does it represent?
Yeah, like is it
Um,
security? Is it proof of concept, progress?
Yeah, well, actually, security is I guess maybe a best way to describe it. It's you feel as though, well, I personally, anyways, I feel as though I have that income source coming in that I don't have to panic about, whether or not I can afford to pay my bills. Um, you know, yeah, it's peace of mind. It really is peace of mind for sure. Just having that extra cash coming in and not have to worry about whether I'm getting my, EI from the government or where, because right now I'm in the process of unfortunately suing my former employer for severance, so that could take up to 2 years. So, but
Right.
I don't have to worry about it at all.
Right. So
Yeah.
security is a big part of that. So that kind of lends well to sort of where I want to take the conversation next. So I always picture our portfolios like two apple trees. So yours is bearing fruit right now, and those distributions are your income, and your tree is still really healthy. So you're showing those withdrawals, and your portfolio is not going to automatically collapse, right? One of the notions that some people discuss out there. But nothing in investing is guaranteed. So a really harsh season could hurt that tree. Meanwhile, I'm growing mine. I'm not picking the fruit just yet. So I'm trying to make it taller so that there's more to harvest later. But I do wonder sometimes, am I missing out on the satisfaction of enjoying some of that fruit now? But I wonder sometimes, am I missing out on the satisfaction of enjoying some of that fruit now?
Yeah, definitely. I can see. I like that apple apple tree sort of analogy that you use. I don't think I would have thought of that. And you're growing, definitely growing, say a bigger tree, like you said, and down the road you'll be able to, reap the rewards of the fruit. Whereas I'm taking it now. But the one thing that you might not have thought of is that we're not taking all of the fruit, right? We're reinvesting. So it's almost like we're planting little trees, right? So we're
Sure.
taking some of our distributions and reinvesting it, planting those little trees so that next month and the month after, we're actually getting more fruit, continuously getting more fruit.
It's like a tree farm then.
Yeah, we're tree
I
farmers.
like that.
Warren
All
Buffett
right.
would be proud.
So a lot of people talk about the risk of covered call funds going to zero, and you've proven that's not happening in your portfolio. But how do you personally assess that risk?
Um, well, I think you have to look at the underlying stocks, right? The underlying holdings of any ETF, right? Whether it's XEQT or VFV or, whatever it is, you have to realize there's something inside of that. That ETF really is nothing, right? It's nothing. But if you own, like, say, Bank from Evolve, inside of that ETF, you have all the Canadian banks and some insurance companies. So unless you think all of those banks are going to go to zero, right, the chances of your ETF going to zero is low. Now there are some companies, like for example, right now Strategy hasn't been doing well, and if you own any ETF with Strategy in it, like MSTE, it dropped from a high of $19 to right now where it's sitting at about $10. So yeah, you can definitely see your position drop fast. You know what I mean? But it is
Right.
still paying distributions. It's actually still one of my highest payers. It's my highest payer, even though it dropped its distribution by 10 cents this month.
Right.
So there is obviously risk, right? And if you have a single stock ETF, the risk is going to be greater. So that's another reason why I have over 40 positions. So I'm not depending on just one of them to provide me with income. And while some might be doing poorly, other ones are doing better, increasing distribution. So they kind of balance each other out.
Right. So that lends to the idea of diversification. So if we take,
Yeah.
well, we've been talking about XEQT, so I'll just stick with that one, the all-in-one fund. That fund is made up of international diversification. You've got Canada, you've got the US, emerging markets, and so on and so forth. So the concept that Paul is talking about applies in the growth space as well. And you kind of touched on a little bit of the idea of value investing, I think, when you talk about a single stock, because that's another way to invest where somebody looks at a company, they figure out what the value of that stock is. But the risk you take by investing in one company is something that you need to assess. And that's why I asked that question to you. So what you're saying, from what I get, is that by diversifying yourself, you're minimizing that risk. Would that be a fair way to characterize that?
Yeah, exactly, right. And I wouldn't I wouldn't recommend, say for example, putting 20, 30, 40% of your portfolio into one stock. Unless you have that conviction in it, like I know at one point I think Warren Buffett had most of his portfolio in Apple, or the largest
Right.
position, over 50% was in Apple. But, you know, these guys have access to information that we don't. So for me, all my single stock ETFs, maybe I have 2 or 3% of my portfolio. If they literally went to zero, it wouldn't affect me that way.
Right.
It wouldn't lead to me not being able to pay my bills or, feed my family.
Right. In your last video, you talked about how you changed some positions, and I am going to make an assumption. Maybe I'm wrong here, but it sounds like when positions, from what I heard in your video, if they're not doing as well, or if they're doing really well, you're rebalancing almost on a monthly basis. So, for some of those decisions you make, how do you make them?
I'm always trying to tweak my portfolio. I mean, as much as I like to be diversified, it's a lot of work tracking all of the dividends that I get, especially now that a lot of them have gone to weekly, right? So every week you're keeping track of every single dividend. I don't know if you do that, but maybe passive probably does it for you. But I'm, keeping track of every dividend, putting it in my spreadsheet. So I am trying to keep my portfolio sort of at a certain number, like maybe just over 40 positions. So I look for ones where maybe I could get rid of them and still be diversified, or still, be producing the same amount of income. The other thing is that there's always new ones coming out, right? So I'm buying new positions. And if I didn't get rid of any of them, I would just, I'd be at the point now probably where I'd have 70 or 80 different positions. So unfortunately, as I buy new ones, some of the old ones kind of have to go. And I do sometimes try and take profits if I see one skyrocketing. But I'll be the first one to admit I've made some mistakes for sure. Like I sold out of some of my Nvidia ETF, my Palantir ETF. I put a lot of that into the MicroStrategy one, and it tanked and they skyrocketed. So yeah,
Right.
I mean, I make mistakes for sure. Everybody does.
So to answer your question, when I started, like you, Adriano's channel and Adrian, so Canadian in a T-shirt, they were the two main channels that I kind of focused. And it's funny because that's what you and I are doing right now, is their different approaches. But they both had some version of a spreadsheet, which I then took and analyzed, and then I started tracking things like you did in a spreadsheet, and then I quickly learned about passive. And I do have a link in the video description below if you decide you guys want to use it. It has a free version. It's great. It also has a elite version that has a bit more metrics to track and things of that nature. But that's what I currently use to track all of my dividends. And maybe in the next video, I'll prepare something and pop it up on the screen so everybody can see what that looks like. There are plenty of choices out there. You don't have to use passive. That's just what I find is the easiest to use. But I do have, and like you, Paul, I was literally tracking all my dividends and all the positions that I held. And it gets a little tiresome. I think at the end of the day, after I learned a little bit, I realized, like, okay, do I really need to track all this? It's in your app. So like I use Simple, and all of that information is also contained within the app. If you aren't, you couldn't remember what was going on. The other thing is, a content creator, we're sharing these things with you. So that's another reason that I track it, is I do like to share it with others, just so you can get an appreciation and use that to make one of those informed decisions. So, um, I was actually thinking about something else that you mentioned there, when it came to your mistakes, and it was we had mentioned in the last video. I mentioned that I had owned QQQY at one time, which you own now, correct?
Yeah, I do. It's
And you
actually
mentioned in
turned
your
into
last
one of my not favorite positions, but one of the ones that's really turned itself around.
right, and that's I thought about that. I watched the video and I was thinking about that. So for those that don't know, when I bought it, it tanked. Like, it was a new security or ETF, and the price dropped like crazy. And I was new, and I thought, this is insane. Like, why am I holding this? So it's interesting to hear now that you've bought in when it's settled out. And I kind of wonder, because I said this to someone else I talked to recently, that I don't consider myself a beginner anymore. I think I'm more like a novice. I think I can have a fairly informed conversation. But with a position like that, I'm wondering, why has it stabilized? Like, why, after so much time, is it performing well? I mean, I know when you bought in it would be, but why is it now performing well, do you think?
Well, so just so you know, Darren, I bought it like you when it first came out, right? So I bought it at the beginning because, Adriano did interviews with the CEO from Defiance, and it seemed exciting and blah, 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 right? So I
Yep.
bought it, and it tanked. Like you said, it tanked hard. They did a reverse split, I think. So I went from having however many shares it was to obviously less shares, but the price went back up. And it was miserable, right? It was terrible.
It
Every
was.
time every time they would pay you a dollar distribution, the share price would drop by like $2. You know what I mean? So you weren't recouping your money at all. Somewhere along the line, I think they decided to stop paying out as much, right? I think they reduced how much they were paying out, and maybe they reduced you know what? I should know this. I should know this, but I can't remember if they put in stop loss, not stop losses, puts, covered call puts. They did. Anyways, they figured out a way to manage it. So now the share price is far more consistent, and the weekly dividend is very consistent. I find it's usually between 19 and 20 cents a week, as opposed to before. Well, then they switched it to weekly. I don't know if that makes a big difference, but I think they used to pay monthly. Um,
Right.
but yeah, so I just started buying more shares to bring my average cost down and see if I could get to the point where I would be either break even or be ahead in the position. And I actually went back and I added up all of the dividends that it paid me, and I was already above. I was already in the green. You just don't realize it because you look at your position on Wealthsimple, and it says, you paid $30 a share, and now it's $25 a share. You're down however, whatever percentage. But if you add back in all of those distributions, I was actually already in the green. So I've continued to buy it.
For the viewers, that's the idea of total returns. You'll hear that term used a lot. So the distributions or the dividends that are coming back out when reintroduced will make your price higher than what it appears to you. Would you agree with that, Paul? Is that kind of
Yeah, exactly.
characterize it?
Yeah, exactly. Unfortunately, if you go on your Wealthsimple and look at your positions, you might think, half of them are in the green, or sorry, in the red, but that's not taking into account all of the distributions that they've paid you.
Yeah. Yeah, so when I owned QQQY, I went through the same thing. That price dropped, and then when I looked at the distributions and noticed that, okay, I'm pretty much a break-even point, that's when I exited that position. And I'll admit, in my case, it was FOMO. It was the same idea. When I started, I'm not afraid to admit that I didn't know. I know I'm older, but yeah, I was watching all these guys, and I thought, man, if this works for them, I should try this. I did that, and now I realize that that's not necessarily the best approach. Everybody's probably going to do it unless you have the opportunity to listen to, well, I guess something like this that will maybe open your eyes to think a little bit more. Like, before you enter a position, why am I doing it? Why am I buying HHIS today? Well, is it because I just heard it on Blossom, or Paul said he should, or Darren did, or whatever the case may be? I'm going to suggest to you that's probably not the best approach. At the very least, go to their website and you can read the fact sheet on it and learn a little bit about it and inform yourself so you can make that decision. Would you agree with that, Paul?
Yeah. And when it comes to covered call ETFs, or even I guess maybe growth stocks, which I don't know as much about, you used your apple tree kind of like analogy. I almost think of it like a sport. You know what I mean? Like if we were to sit down and talk about hockey or football, right? You could say, take a look at the New York Jets. Right now they're like 1-7. They're a terrible team. Like why would you invest in them? You wouldn't, right? But then take a
Yep.
look at another team that's maybe undefeated, or has a better record. That's the team you'd want to invest in. But they're both playing football, right? So there are a lot of covered call ETFs, but they're not equal. You know what I mean? There's some of them that are
I do.
terrible that you should just stay away from. And then there
Yeah,
are other
that makes a
ones
lot
that
of
are doing
sense.
fantastic, right? There are ones that are really, really good. So the question is figuring out which ones are the better ones to have. And it's a
Right.
balance, right? Because the more income they pay, the riskier they can be. So you kind of got to find that medium of where it's going to produce enough income for you without the share price going completely down, or
Right.
or going up. Like if you look at GPIC from Goldman Sachs, I think in the last 2 years, their share price is up like 30%, and it's still paying you a monthly dividend.
Right.
Yeah.
So for someone that's already generating income, does growth still matter?
Um, Not as much, I don't think, but I do like seeing my portfolio grow. Like I would love to see my portfolio. I know you're looking at, I think 500,000 is kind of like your next goal. I'd love to see my portfolio hit $500,000.
Yeah, so for the folks that are either new or, well, I guess if you've been following me, you'll know that. But I do have a way of tracking my goal. Actually, Passive showed it if you go back and look at that tile that I put up. I based it on retirement. And just so we're clear, guys, or folks, that when you retire and you start using this money, that's equally important to building your portfolio. And I was actually asked at work, hey, you should do some videos on that because it's true. Like the tax implications when you take money out are equally, or if not more important than building your portfolio. So, yeah, so I have actually adjusted the goal, but the original goal was 500,000. I do have a pension, so this is my wife's essentially, and it will balance our income when we retire. I went back to the calculator and plugged a bit more numbers in, and it's going to be around 577,000. But I've set it on Passive at 500,000 right now.
Nice. So you're hoping to get
So
to 570.
yeah, 570 would be the goal to get to. Now, obviously, the way things are going, for those of you that have new, I started in 2023, and yes, I'm contributing a significant amount of money to this portfolio. And one thing I'll emphasize is if you're younger and you're watching this, and I would suggest that you want to seriously consider what style of investing you're going to do. Start something simple. Take care of your debt first and then start putting $100 a month or $25 a month. Don't wait till you're older like me and all of a sudden have to play catch up. So for those of you that think like, oh, well, Darren's portfolio is only growing because he put money in. Well, I showed you the numbers. I was very transparent. Yes, I'm putting money in, but there's still a lot of growth. Compounding is the key to it. And Paul's portfolio is similarly doing it's performing or the same way. That's compounding. You reinvest those dividends.
Yeah, and the nice thing about having an income portfolio is that let's say in the next 6 months the market tanks, or maybe we go into a bear market and it starts to go down. I'm not worried about selling any of my positions, you know what I mean, to live off of the income and selling at a loss. Or, I'm not worried about having to have like a $50,000-$60,000 cash wedge that I know some people use as a strategy. They keep a certain amount of money in a high interest savings account or something for those periods. I'm sure in a bad time, the monthly income is going to go down for sure. It definitely will. But at the same time, as things are less expensive, we can buy more ETFs at a cheaper price. And then when the market, the cycle goes around again and things go up, that's when you'll see your portfolio, my portfolio will skyrocket again.
Yeah, that's actually a really good point to make. So, from my perspective, as I'll call myself a hybrid investor, I don't think I'm truly a true growth investor, but and I've actually had some comments about does that even matter? I don't know. I guess to a certain extent it does, but when I look at what I've learned, the markets change. So, if we zoom in on the market today, actually is a good example. We saw what we said maybe $4,000 or $5,000 drop in the market, so our portfolios obviously adjusted accordingly. If you look at that today, you're going to see quite a dip in any tracking software that you're using. But if you zoom back out after it corrects itself, it's going to look almost like a straight line with slow, steady growth along the way.
Yeah.
So I had to wrap my head around that idea. And the cash wedge that you talked about is definitely something I think people need to think about as they get closer to their retirement date. The reason for it is, like you said, if you don't follow an income strategy like you do, you need to have your income ready to rock and roll and not tied up in something that could potentially be down 30, 40. I think the worst case scenario I've seen in history is like 50% drawdown on markets. For me, the time frame is long enough that I'm not concerned yet. The closer I get to retirement, then we can start considering that is it going to be income, GICs, some cash wedge, or something similar to that. So these are things to think about, not just, hey, look at how much money these guys are making with their portfolios. Do you think that some investors underestimate the trade-off between income and growth because they haven't seen a true bear market yet?
Possibly. Maybe you're insinuating like that the income side of it will not do well during a bear market. I mean, 2020, was it 2022 was a pretty bad year. I know Adriano had his channel starting in 2019, but we all made it through 2022. And even though I don't know if you follow his channel, but there are times where his portfolio swings by hundreds and hundreds of thousands of dollars. But if you look at his monthly income over time, it's phenomenal, right? He's gone from about 6,000 or 4 or 5,000 a month in 2020 to where now he's making like 30,000 a month. So no, yeah, I guess maybe people do underestimate. Yeah. So I don't think they're part of Blossom, but there's a couple that are part of Adriano's Facebook group, right? And I won't say their names, but they're school teachers, retired school teachers. And the husband, he's been posting for a few years now. Okay. They took
Yep,
all the money out of their pensions and invested it. You're frozen again. They
I can
invested
hear you.
their money. Okay. And a couple years ago, they were making something ridiculous like 20, 25, $30,000 a month. They're up to 80,000 a month now.
Wow.
How many school teachers are making $80,000 a month? And they're retired.
That's a lot of money.
It's
And teachers
insane.
typically have fairly good pensions as well. I know my aunt and uncle are teachers, and they travel a lot and stuff like that. Now,
Yeah.
on the other hand, there's a lot of trade-offs to being teachers because you don't get days off like most people do, Monday to Friday kind of deal and stuff like that. But
Yeah.
that's pretty interesting. No, I don't know them.
Yeah, I'll when I get a chance, I'll find his portfolio and I'll send it to you. Just to take a
Okay.
look. It's crazy.
All right. Would you ever consider adding more growth-oriented ETFs to your portfolio, or do you feel the all-in-one income right now works the best?
So I do have a plan. I think that once if I can get my income up to $15,000 a month, I think at that point in time, I'm going to start buying something like XEQT again. I like XEQT. I don't know if you know the difference between that and FEQT, but I like FEQT as well. They manage it differently, and it's got something like 3% Bitcoin. So, it's like, I mean, I know XEQT already has what, 8,000 stocks, but I like the
Yeah.
diversification of owning both of them. So I think I will start adding a little bit of growth to my portfolio.
Yeah, so you mentioned FEQT last time we talked. I can't remember if we included it in the video, but I was trying to look it up when we were talking last time. But for the audience, you know what? I think this would be a great way to segue into some of the growth talk with those two ETFs. So maybe next video, guys, we will, Paul and I will chat. We'll dive deep into those particular ETFs. I think that's some great content. And then we'll contrast that at some point with talking about some of the covered call ETFs, because you mentioned, Paul, that some are good and some are not. And so we can contrast those in some of the upcoming videos. I think that will make some great content for you guys. You tell us, leave us in the comments what you might like to hear us talking about. And I'll be honest, I don't know anything about FEQT, so it's going to be a learning experience for me as well, but we'll be able to share that with you guys.
Sounds good.
For someone still in the accumulation phase like me, do you think it ever makes sense to use covered calls at all?
I do personally, yeah. And one of the reasons why is because you don't want to necessarily, like, if your plan is to switch to income at some point, you don't want to, be a growth investor, say, until you're 58, and then all of a sudden go, okay, now I'm going to sell all my growth ETFs and become an income investor and have no clue what you're doing, right? So if you start small now and kind of like learn a little bit, right? Kind of dip your toe in the water and get a feel for how they work, maybe test out some fund of funds, some individual stock ones, and just kind of learn as you go. And then that way, not only that, but you can build an income portfolio. Say you're making $500 a month. Take that $500 a month and put it into VFE, right? You can fund your growth with income.
Okay, so Paul, in this conversation, we've talked a lot about the differences in the strategies. And one of the things that we've seen on Blossom, and by the way, guys, if you don't know, Blossom Social is a great place to learn, connect with other investors. Links are in the video description of both of our channels, so make sure you check that out. And we both have referral links if you want to use that as well. It helps support our channel and our efforts. Now, Ben Felix is someone who's in the industry, the financial industry. He's put out a lot of videos about covered calls. Most of his content is about evidence-based approach to understanding the strategy. And he did a third video recently that I understand that you haven't watched yet, Paul. And in that video, he laid out the importance of time and how it affects an all-in covered call strategy. And I think it's good to talk about it now because you did mention that you're going to start introducing or potentially introducing growth. And in this slide that he demonstrated, he shows how using strictly covered calls over a longer period of time will lag the underlying assets, and you can see this great difference. So does that surprise you when you take an evidence-based approach to investing and when you look at that, when there's all this back and forth with covered calls?
No, not at all. And I think a lot of income investors are willing to give up having a larger portfolio or better total returns in the long run in order to have the income now and be able to enjoy the money, enjoy your life at a younger age, as opposed to trying to keep working and accumulating and maybe someday reach like a $2 or $3 million portfolio and then using a 4% rule or whatever that strategy is. So it doesn't bother me at all. I think we assume that we're going to underperform, and sometimes when we actually outperform, say, the S&P 500, it's kind of like a bonus, to do that. But it's not the goal, right? That's not our goal. So I'm not surprised at all. And I think that's why some of these ETF companies now are starting to use 25% leverage on their ETFs, is to try to make up for the lag of not capturing all the upside.
Right. I'm going to touch on one thing you mentioned earlier. You mentioned that one of the ETFs had cut the distribution. I think it was MSTE. I can't remember
Correct.
which one it was. And it's the same in any other security. Like, we'll take Enbridge as an example. For the longest time, there were people out there saying, like, why do they have such a high, dividend, and they should cut it because it's based on their what's on the books. And if they can't pay it out, why are they doing that? They're only hurting the company. Well, I think you're saying the same thing here, which is you as a covered call investor want to be invested in things that they're not giving you high distributions that they can't support.
That's right. Yeah, for sure. It's unfortunate because, as you're building your portfolio and you're reaching new goals, like maybe $1,000 a month, $2,000 a month, and then an ETF like MST reduces their distribution, it's almost like two steps forward, one step backwards. But like you said, you don't want them paying you out money that they're not earning or that they can't afford to continue paying over a long period of time. Over a short period, it's okay. But over the long period of time, you don't want them eroding the NAV, right, of the fund, just to continue paying you those distributions. And is it Enbridge or was it Bell? Can't remember which one it is, but one of them had, a dividend that was so high, and they kept increasing it. And the problem is that they become known as an income providing blue chip company. And the risk is if they cut that dividend, people will bail on the stock, right? And the stock price will plummet.
Yeah, I
It's
believe
not,
Bell ended up cutting their dividend. I could be wrong on that, but yeah, Bell was the other one alongside of Enbridge.
yeah, yeah. It's just funny. I actually sent a friend of mine a video. I think it was the Dividend Guy did a video about Bell and how the company is really underperforming and it's not well managed at all. And he sold his shares that day, and it saved him a lot because it plummeted right after he sold it.
And that's another reason that I mean, at least for me at my stage, that's why I kind of like the idea of ETFs. I've said it before. I set a goal this year that I wanted to learn how to do some value investing, or at least learn how to do it. But when I think about the amount of work that it takes on top of everything else I'm doing as a content creator and regular work and stuff, I don't know I'm there just yet. But yeah, like to understand about one company is a lot, or I could just buy an ETF that holds that company and I get some exposure to it depending on the percentage that the provider holds within that ETF. So one thing that I've learned through all of this is that yield doesn't equal income. High yield looks great, but if part of that payout is just my own money coming back, considered to be a return of capital, it's not really new income. When you look at those monthly distributions, Paul, do you think about where the money actually comes from?
Yeah, of course. Yeah, you have to look at total return. Like you were mentioning in a previous question, we were talking about your share price, plus the distribution. So you are looking at total return. That's important. But also, from what I understand, there's more than one type of rock, right? You have the bad rock where they're just paying you your money back essentially and eroding the NAV of the fund. And then there's the good rock where it's just an accounting term. So it's kind of like a capital gains at the end of the year. That's how you get taxed, or when you sell, right? That's how it's considered. So it's the way I look at it is if an ETF stays kind of like in a certain, I think Perry calls it a price box, or maybe that's the term for it, where the share price kind of goes up and down, but it continually pays out the distribution, then I'm happy. If you buy a fund at $20 a share and it's just going from 20 down to zero, then yeah, that would be a little bit worrisome, right?
And so you've answered my next question was, does it matter to you if part of it is rock, or do you view it all as just usable income one way or the other? But I think that leads maybe to a question that I hadn't thought of, which is, so if you see that going on, and I used QQQY because I bought in early, what do you do? How do you manage that?
So I have this problem mostly with my yield max funds, like the single stock ETFs, like Tesla and Misty and Coney seem to be the ones where the share price or the NAV have plummeted the most. And I'm currently trying to look for ways of exiting those positions, but I don't want to sell. Believe it or not, even though their share prices are down so low, they still pay really good distributions. So I don't want to sell one and buy something else and end up reducing my monthly income. But what I am trying to avoid doing is I feel like the next time we have a big correction, those particular ETFs are going to drop and they won't recover. So I'm going to end up losing a lot of capital. So I'm trying to balance off selling them, getting rid of them at the right time, and not losing monthly income, but also avoiding a big capital loss the next time the market crashes.
Right. You're hitting on a really key point, which is why I think that a lot of people have such strong emotions. I'm going to use that term around the cover call strategy, but you're acknowledging that. The fact is, you've acknowledged that you're going to give up some upside. We know that. You're also acknowledging that in a huge correction, which I think is coming, I think statistically we're going to see one in the near future. The question will be, how do you manage it? And I think you're laying out a plan already, which sounds to me like you're going to introduce some growth to hopefully offset some of that as well. So kind of like a hybrid investor. Would that be kind of a good way to characterize that?
It is. And the other thing I'm doing is that I think most likely, and I could be wrong, but I think the tech stocks are the ones that are the highest right now, the ones that are probably most overvalued, and they'll probably lead the way when the market crashes. But then I find the opposite is all of a sudden your utility stocks and banks and other ones tend to go up because people are going to start selling out their tech stocks and they're going to move the money into things like utilities because they feel like it's safer. So what I'm doing now is I'm going to start buying more covered call ETFs that hold utilities, hold banks, like the more boring, the more boring ones, but the ones that will probably rise when the market crashes. Then you can use that money to buy the tech, which is now going to be on sale.
Right.
Yeah.
So do you think most investors understand the difference between yield and true income?
Um, yeah, maybe not. Maybe not. I guess you have to look at first of all, you have to look at your yield on cost, right? If you paid $20 for an ETF and now it's trading at $10, the yield on the $10 share might be 40%, but the yield on your purchase at $20 is going to be a lot lower. So yeah, it's very individual, right? It depends on you and I could hold the same stock, but if I paid $50 for it and you paid 100 for it, my yield's going to be better than your yield. So you really have to understand the yield, the distribution rate, and how it matters to your portfolio as opposed to somebody else's. We could own the same
Right.
stock and I could be up and you could be down, right?
Yeah.
You know what I mean? If I bought Palantir at $50 and it went to 100, I'm up. If you bought it at 120 and it went down to 100, you're down. So
Right.
a lot of it does have to do with timing the market, I guess.
Right. So if your yield dropped from, say, 12% to 7%, but your total return improved, would you care?
Um, I don't know if I would care, but I might be a situation where I would say, okay, this ETF, I started buying it at $8 and now it's $16 a share, but they haven't increased their distribution. I might look at selling it, realizing that gain, and move the money into something that has a higher yield or a higher distribution.
Right. So do you think that too many people chase the number, and I'm going to put it in quotations here, the yield, instead of understanding what's behind it?
Oh yeah, 100%. Because I bet you half of the messages I get on Blossom are people asking me if they should buy something like Alti, right? Because they see everybody talking about Alti and it's got an 80 or 90% yield. So, they're just, they're chasing the yield, as you said, right? And they don't realize that, sure, it's paying an 80% yield, but it's also an ETF that went from $20 a share to $5 a share. So, people are definitely chasing the yield. And I'm definitely somebody who's always trying to increase my monthly income, but I also try to balance it out by owning ETFs like HYLD that don't pay as much, owning Q Day and S Day. And, there's a lot that you try to mitigate your risk by owning the ones that are not as high volatile and high yield.
Right. It's funny. I was reading a post about S Day. I'll be honest, I don't know anything about S Day because of the positions that I hold. But I heard this person talking about what was inside of it, and that got my attention. So, with so many ETFs, it's kind of hard to keep up with what they hold. But I think what's important is it highlights the importance. If you're watching this and you've heard Paul and I now go over lots of different things, you should be going to that website right now. What's in that fund? That's the first place to start. There's lots of key information that you can learn from that. And then look, are there other ETFs that will hold the same thing? Or if you wanted to buy a single stock position, I suppose you could look at that as well. So I think that we're both showing that, there's more than one path that can work as long as you understand the trade-offs. Your portfolio is still growing even with withdrawals, Paul, which challenges the idea that covered calls automatically go to zero. But nothing's guaranteed, and you have acknowledged that the markets could take a big change here. And even at the best strategy can suffer in a rough stretch. That's true, it can happen. So, how do you think your strategy might handle that downturn if we moved out of this bull market into a bear market?
That's the thing, Darren. Like when people say that, covered call or income strategies don't work, the thing that I don't understand is how can my income be growing monthly? My portfolio is growing in value. So
One of the best comments that we got, Paul, after our last video came from a viewer named JC. Hope I pronounced that right. It was suggested that we run an 8-year projection. So that would look at our portfolios out that far. So your portfolio with its $1,000 monthly withdrawals and my portfolio with the continued contributions, we could see where that might end up. And I really like that idea because it takes all of this theory and turns into something visual and real. Would you be open to that idea, Paul?
yeah, I think that's a great idea. That'd be a lot of fun. Hopefully you know the technicals to do that.
Yeah, so that will be the next part, folks, is I'm actually open to comments. Leave it in the comments below. I only know of one website that I can use to make those projections, but if you know of something simpler for us to use, please chuck it our way in the comments, and we will definitely work on that because I think it would be an interesting comparison. I think the only herring that we've now seen, folks, is that Paul's talking about introducing some growth, but it will be equally interesting to then lay that out over time. At the end of the day, this isn't about who's right. It's about learning. Growth and income both have their place. And the more that we understand how they work, the better decisions that we can make. And don't forget to check out Paul's channel, Better Call Paul, where he shares his income strategy in full detail. And if you'd like to see how my own growth focused portfolio is actually performing, what I'm holding, what's working, and what I've changed, check out my latest video from my portfolio update right here. It's a great way to see how all of these ideas come together in real time. Thanks, guys, for watching, and we will see you on the next one.